Well, lately nobody seems to care about this anymore, but in tonight's video, we're doing a little bit of a reality check to make sure you're not caught off guard. More importantly, we'll cover the current market conditions and how to navigate any upcoming storms. Stick around to the end because we're also diving into some updated signals in the crypto space. You're watching the Stock Market Brief Show, where we navigate the financial markets through the lens of technical and intermarket analysis. If you haven't done so already, subscribe to the show. Let's get into it. Welcome back to the show, everybody. You may be seeing this fly all around the internet, and this is the CNN Fear and Greed Index moving back into extreme greed. There's been times where we've hit this many times before. We've seen consolidations and pullbacks. The last time that we've been in here was earlier this year, where we kind of stayed into a state multiple times. So I went ahead and highlighted the times that we got into extreme greed and when we started moving out of it. And you can see we went through consolidations, still pressed higher, and then we saw corrections. Other times it knocked pretty good timing as saying getting into extreme greed, holding it, and then crossing down and seeing little pullbacks in the market. And we're moving into a state of extreme greed once again. Does that mean the market's hitting the top right here, right now? Not necessarily, but it is moving into a state where it is getting into those overbought conditions. And it's happening during a time where we're seeing the US dollar rip roaring to the upside and the 10-year yield rip roaring back to the upside despite the Fed already cutting rates. And why is this important? Well, if I went ahead and showed you the US dollar here, the 10-year yield here, and the S&P 500 here, what I wanted to call out is when we started seeing tops in the dollar and the 10-year yield and they started moving down, what took place with the S&P 500? The S&P 500 began moving up significantly. And this is the typical correlation that we saw, especially going back into 2022. And why I find interesting now in recent trade, if you look at this little zoom thumbnail over here, they've been all on a monster tear. So who is lying? Yes, correlations, they come and they go from positive to negative. So which one is going to really cause this correlation to fall back into place? Or are we actually going through a period of time where we're really seeing something change from an intermarket perspective? We got to be open to both scenarios. Here's a chart that nobody seemingly cares about anymore. It's the yield curve of the 10-year 3-month. And you can see where we currently stand now, the 2020 recession when we got inverted and we started uninverting, the great financial crisis, the dot-com, and even the 1990s recession. And you can see that times when we started uninverting and steepening is when things got a little rough. And well, you can see we're starting to steepen right here. And you might be thinking, well, yeah, it doesn't matter anymore. Well, I think if you look at this chart, it might change your mind because many of the times where we started hitting new highs in the market, it happened to do so while the yield curve was also still inverted. We started seeing more volatility in the markets when we began to uninvert and the Fed began cutting rates at a steeper pace. If you take a look here, I found this to be interesting. Of the times that the 3-month yield curve was inverted on the 10, 20, and 30-year basis. And you can see it's the 10, the 20, and the 30-year, and they're all starting to steepen quite rapidly in this current context. You can see over here in 2007, and then also here in the dot-com bust, they were all inverted at the same time, even slightly here for a very, very quick moment going into the pandemic as well. So there will come a time where these uninvert. If I zoom in on this, you'll see that they are steepening at a rapid rate, and even the 20-year 3-month looks to be almost uninverting at this particular point in time. It's at 0.17 basis points inverted. When it gets above zero, obviously, that means it's no longer inverted. And you can see the times that we did start to get back into a regular state or when they started to steepen further and the 3 months started to dip, which obviously, if you look at this pink line, it looks like what? It looks like the federal funds rate. And you can see as these came off significantly, we started seeing more volatility here in the markets. And each time, like I stated, they were at all-time highs in the marketplace. Now, I thought this was kind of interesting. This was, you don't need to take it from me. You could take it from the Federal Reserve. They actually publish this out, I believe, monthly. The last one that was updated was October 3rd. And it tells us the probabilities of a U.S. recession within the next 6 months to 12 months ahead. And that's this chart right here. And the probability is at about 57%. And it's been up in this high trading range for quite some time. And if you look back, right, we haven't seen this since, as high as where we are since the 80s. And you can see these shaded areas are times that we've had recessions. It was always when these steepened here. And then if you look above on this is the 10-year 3-month yield curve. And as it currently stands, they're not really tracking where it's currently at. So this isn't fully updated. So it's going to be interesting to see when this updates the following month or when they do update this. But this will be closer to a potentially uninverted state. And if you just look back over here at the times we had recessions, it was what? When we began uninverting, and then also when we began uninverting all these other times here is when we saw the recessions take place. So is this the market trying to tell us, hey, there's a high probability of a recession, and when we become uninverted, we're getting closer and closer to that point. And what does that mean for the markets? Well, we're going to look at the market conditions as a whole here momentarily. But what else is going on in these markets? Well, let's take a look at the Buffett Indicator, where it takes the total U.S. stock market value and divides it into the annualized GDP, and it spits us out a percentage point. And right now it's at 209%. And if I just pull up this chart, it shows you a historical trend line of this, and it gives you a 1 standard deviation, 2 standard deviation. And right now, we're actually going to the all-time high in this valuation. And you can see that we're hitting above the times through after the pandemic. So it's a very high reading currently, or a overvalued potential market. And you can see if I even go into this chart specifically looking at value versus historical trend, you can see we had the internet bubble over here when we had a 2 standard deviation move, and we found the bottom of the financial crisis when it became very undervalued. And right now we're actually more up into this range as it stands in the strongly overvalued area. Does that mean everything is going to come apart at the seams? No, not necessarily, but will it look obvious in hindsight if something did come ripping apart at the seams? And I think the answer here would be yes. How did you not see it? Why would you overlook it? But it's important to understand how we navigate that. And that's where I always go back to the market conditions. First and foremost, if you're an active trader, one way to quickly look at market conditions, how I look at them from a swing trading perspective, is the direction of the 5-day moving average. And you might be a longer term trader, so you might be looking at the direction of a 20-day, a 50-day, a 200-day, whatever the case may be. But right now, as it stands, I'm looking at the 5-day moving average of the SPY, the Qs, the IWM, DIA, XBI, and semiconductors. And guess what? Check, 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 check. That is 6 checks, I think, if I recalculate there. They're all above a rising 5-day moving average. And then I look to see the gamma flip line. The gamma flip line tells me how dealers are going to, respond to market movements. If we're above a flip line, guess what? They're going to be buying the dip and selling the rip. And this is where volatility typically decreases. When we're below the gamma flip line, this is where volatility increases because they sell into selling, they buy into buying. And right now we've been on a monster run. So does that mean that it's the best time to buy right now and head up to 5,900? Well, maybe you're charting to shoot for 5,900. But if I just pull up an RSI, you can see in the short term, things are getting a little frothy here on all these averages. They're actually pretty much in all overbought conditions or have little divergences. Now, with that said, market conditions are, very bullish, right? We're at all-time highs. There's nothing to fight there. However, like I said, things could get a little extended. So how do I look to trade this type of price action? Well, I'm looking to be a buyer at any time and add exposure when we are above a rising 5-day moving average and when we're in positive gamma territory. However, in the case where the market has already made a pretty significant run, I look for pullbacks in areas of digestion. So what I do is I look at the daily expected moves and the weekly expected moves. And when I'm looking at the daily expected moves here, I do find this to be quite interesting that the expected move going into tomorrow is 581.50 to the downside, 587.15 to the upside. And that's a rather small range right there that the market's pricing in based off of options implied volatility. So if I look at the VIX volatility index of the S&P 500, it's still near 20, which is pretty wild to me. This means that we're kind of in an area where you can see this market do a lot of head fakes. So I went ahead and gave you the implied move for the VIX as well, which is the index, the S&P 500 volatility index. And that gives us a zone down here for the downside, which is up to 576.88, and in a zone to the upside, 591.62, which would be above our weekly expected move at 588.41. So right now, if price starts pulling down and we get extended through the daily expected move, say tomorrow, say if something comes back and we get all of a sudden rip down tomorrow, I'd be looking for strength within this zone and, for a higher low to take place, the 5-day moving average to come up, and I'd be looking to buy as a continuation move. Now, if it starts moving into here, I'd just be letting my foot off the gas, maybe take some profits on some of my individual trades, and I'd wait to see how things consolidate up in these areas, see if the 5-day moving average catches up, if it flags out and wedges. So right now, I'm not much of a FOMO. I'm now waiting for a pullback and a higher low to form, and if we get continued move, I'm looking to take partial profits and just update my risk parameters as I see fit in the market. So those are the big moves for tomorrow. The daily expected move to the VIX, these zones, the red one to the upside, green one to the downside. And if you're wondering in terms of probabilities, well, it's about almost a 70% probability that we close within this range. As I previously marked out, this would be one standard deviation. So 68% of the time it finishes within those areas. With the S&P 500, it's typically a little bit higher. Okay. So that's what we're looking at as far as current market conditions, right? We went ahead and we looked at the larger picture, which could be scary, but just because something's scary doesn't mean you don't want to take advantage of what's currently going on in the markets. So as I stated, the current conditions are bullish. We're hitting all-time highs. The overall bigger picture can be scary, but I think it's important to note because when the shorter-term conditions change, when we get below a declining 5-day moving average, when we get into negative gamma territory, things like we're pointing out over here can happen. That's how things have happened. So that's what we got to pay attention to from a shorter term perspective. Let's hop into some crypto charts now because we're talking risk on for the most part right now. And well, the Sailor to Shift tool, which measures the rate of change between Bitcoin and gold on a 4-week basis, gave us a buy signal about 3 or 4 weeks ago, but right over here because it went into positive territory, but we failed to break a high of the trading week to give us that initial trigger. Now, if you have no idea what I'm talking about on this tool, I shared the tool. Just do Sailor to Shift tool, figuring out money, or Mike Silva. You'll find it. I tell you how to build the tool, how it's used, and how it's caught every big run up and every big decline in the price of Bitcoin, including the one right back here, going into 2021, that big move. And then it saved us from this. And then it saved us from that. And then it saved us from this. And then it caught this. And then it caught that. And then it's been choppy in this little flag formation. But it did give us a trigger because we crossed above the prior trading week. So there you go. As long as we stay above here now, we are on a buy signal, buy trigger. When it crosses back below, that is going to be the sell signal. And then from that point, we look for a sell trigger. Now, if I just look at the price of Bitcoin over here, you can see price has been just going sideways. And this is what I was hoping to see is a recapture of the 200-day moving average. Now, I wanted to see it hold up here for it to start to flatten out and turn back up because it was getting a little dicey as we traded underneath it over here and it starts rolling back over. It could say that, hey, the longer-term trend is changing. We could head down, which could still be a potential possibility. We don't know. But as it stands now, we're bumping our head back onto this trend of a larger consolidation that if this does want to start breaking, perhaps this buy signal can lead us to some new all-time highs in the price of Bitcoin. If we take a look at Ethereum, the 200-day is declining, but if you do look here from just a technical standpoint, you might call this an inverse head and shoulders of, you might say, no, it kind of extended past the head here, or you might look at the closing prices, and then that would be an inverse head and shoulders with a diagonal neckline like so. And if this is the case, if we break this neckline, it could take us back up to and around 3,000 to 3,200 as far as a measured move goes. That's all I got for you on today's episode, everybody. Hope it helps out see the bigger picture versus the shorter picture and how to differentiate between those two and prepare for what we can control in this market, which is risk. That's all I got. See you later.